In this presentation, we will take a look at overhead cost variances. First, we want to recall that overhead is going to be that bucket of items that we can't apply out to the production process. Typically, we're looking at a process cost system or a job cost system, and we can't apply these items that are going into overhead to a particular job or a particular process. Therefore, they're going to be put into the overhead. Another way to look at it is when we produce the inventory, we typically think of three components that will be included in the cost of inventory, that being the materials, the labor, and then the overhead. So we're thinking about the overhead here. Typically, the overhead will be going into this bucket of overhead, which will then have to apply out to the particular job or process, and we'll usually use a predetermined overhead rate in order to do that. So we want to remind ourselves that what the predetermined overhead rate is, so that we can then move forward with the flexible budgeting process and the reviewing of the budgeting information with relation to overhead. So the predetermined overhead rate is going to be equal to the estimated total overhead cost. So we're going to estimate what we think the overhead cost will be, and we divide that by the estimated activity. The estimated activity is what we're going to use to determine how big, if we're talking about a job cost system, is one job is to another job, so that we can then allocate the overhead to the proper location in relation to the size of, for example, the job. So the activity base then could be something like labor hours. It could be materials or machine hours or something like that that will help us to know which jobs are going to be bigger, which jobs are going to be smaller. So this is going to be our estimate. We'll have the estimated total overhead costs, what we think that will be, and then we'll divide that by the estimated activity, whether that be machine hours or labor hours. We'll use this predetermined overhead rate then to allocate the overhead or estimate the allocation. The assigned overhead then will be the predetermined overhead rate times the standard activity. So the standard activity times the predetermined overhead rate is what will be assigned with regards to overhead. Overhead standards. The overhead standards are going to be the amounts expected to occur at certain activity levels. We're going to have the standard overhead rate. The standard overhead rate is going to include fixed overhead rate that declines as activity level increases, as well as variable unit rate that stays constant at all levels of activity. So in other words, when we think about the overhead, it could have fixed components to it, and it could have variable components that are grouped into this bucket that we call overhead. And we're going to try to apply a rate that it's going to be treating it kind of like it's variable in essence, because we're using this rate that is going to be applied as if it was a variable kind of activity. But we know that there's going to be a fixed component to it, and fixed components will be treated differently as activity levels go up. As the activity levels go up, as we produce more stuff, then the fixed overhead rate will decline because we're making more stuff and we have the same fixed costs, whereas the variable unit rate stays constant at all activity levels because it's variable, meaning as activity levels go up, the rate would be the same because it's going to stay the same at the increase in activity levels. The slope of the line will be the same. Now we might put together flexible overhead budgets. Those are going to be budgets showing amounts of overhead for various levels of activity. That can be used to analyze the overhead costs. So we can use a flexible budget, in other words, and we can think about different levels of activity in order to analyze those costs. It might look something like this. It's going to be an example of a flexible overhead type budget. We have the variable amount per unit. We have the total fixed costs here. So the fixed costs are going to be here, and then we have variable components of overhead. You'll note that if we have the production in units, we're going to say that the production is 3,500, 4,000, 4,500, or 5,000 at capacity. In other words, if we think that we're at capacity, 100%, we're making all the units that we can, that would be 5,000. If we say that we're at 70% of capacity of the 100%, we're going to say it's going to be 5,000 times 0.7 or 3,500 units. So we're going to estimate, well, what if we only make 3,500 units? We don't know exactly what we're going to be producing at, and therefore we could be at 70, 80, 90, and we're using our flexible budget to consider the overhead at these different activity levels. So then if we had total variable costs, at 3,500, 4,000, 4,500, 5,000, them varying with the level of production, with the number of units that are being produced. And of course, they vary by the $1 here, right? So the 3,500 times 1, 3,500 to 4,000 times the 1 is the 4,000. And then we have the fixed costs. The fixed costs remain the same. So the activity levels go up. The fixed costs are going to be the same no matter how many units we make up top. Then we get the total factory overhead, that being the variable and the fixed components. So we have the variable and the fixed components. If we take the standard labor hours, and that's going to be our activity base, that's what we're going to use in order to apply the overhead, we get the predetermined overhead rate per standard direct labor hour, and that's going to be 2.14 if we're at 70% capacity or make 3,500 units. In other words, we take the 7,500 divided by the 3,500, and that gives us the 2.14. Notice that we're going to have rounding no matter what, so there's always going to be rounding issues that we're going to have to deal with, rounded to 2.14. And then if we take the activity level at 80%, we've got the 8,000 divided by the 4,000, and that's going to give us the 2. And of course, if we continue this process, the 8,500 divided by the 4,500 is the 1.89 about. Now, you'll note that as we think about this number here, it is including both a fixed and a variable component. We have the fixed component here and the variable component that's included in the predetermined overhead rate per standard direct labor hours that we're then going to use to allocate out. Now, we're going to be considering here our 80% of production at the production of 4,000 units as we move forward. The overhead cost variance, so when we consider the variance, we're thinking about that difference. We're thinking about the difference between the total overhead cost applied to products and total overhead cost incurred. So when we're considering the variance, once again, we're thinking about what we applied out, what we estimated to happen, and then applied with it, compared to what actually happened, what actually occurred, that difference then being the variance or the difference, the change. So the overhead cost variance, or OCV, will be equal to then the actual overhead incurred, or AOI, minus the standard overhead applied, SOA. So this is going to be our formula, of course, the overhead cost variance, the change, the actual overhead incurred, minus the standard overhead applied. Let's continue with our example. If we had a company that produced 3,500 units and worked 3,400 hours, budgeted for 80,000 capacity and 4,000 units, actual variable overhead 3,650, and actual fixed overhead was 4,000. In that case, if we're going to calculate the overhead cost variance, we're going to say that it's going to be the 3,650 plus the 4,000, that being the actual variable and the actual fixed components together. And then we're going to subtract out the standard overhead applied, that being the 3,500 times 2, which was our activity base at the 80% level. And that's going to mean that the overhead cost variance, OCV, is equal to 650. So we added these two up, we multiplied these out, we subtracted them out, we got the 650. That's the overhead cost variance. Now we're going to look at that variance, we're going to look at that change, and we can once again break that out into the components. We can break that out into the overhead controllable variance and the overhead volume variance. So we're going to take that total difference, that total change, overhead controllable variance, overhead volume variance. The overhead controllable variance is going to be the actual overhead, and this is what we would know because the actual overhead would be what we have given after we run the process, 7,650 minus the applied overhead. And if we look at our flexible budget, we've got the applied overhead at the activity level, the production in terms of units of 3,500 to be 7,500. Subtracting those two out, we get the 150, the controllable variance. the overhead volume variance, and the overhead volume variance is going to be the other portion, the other component to get to the total variance of that 650. So the overhead volume variance is going to be the budgeted fixed overhead at the production capacity, the 4,000. And then we're going to have the applied fixed overhead. That's going to be the direct labor hours, 3,500, times the predetermined fixed overhead at the predetermined capacity of 4,000. So note, we're only looking at the predetermined portion. When we have the predetermined overhead rate, when we had the capacity of 80% or the 4,000, it was $2. We're only looking at the predetermined component here at the 4,000 that we had determined it to be, the capacity level we determined it to be, which is $1. And so therefore the 3,500 times the $1 is 3,500. That's the applied fixed overhead. The difference between the 4,000 up top and the applied fixed is the volume variance, 5,000. 500. 500 plus the 150 is the 650. That's going to be the total variance, which we saw calculated here.